Hello, everybody. It's Monday, May 4th, 2026, and the year is just whizzing along here. Already in May, it's been a heck of a roller coaster ride in the stock market. Yet, at least the market has managed to recover from its March 30th low. I still think that was the low for the year, and I think the market is still heading to 7,700. But I also recognize, as we all do, that the war isn't over in the Middle East. Today, Monday, May 4th, there's some developments that suggest that the ceasefire isn't exactly working out today, anyways. Apparently, a drone was shot by Iran at one of its neighbors. And then there was some talk about the Iranians having done some damage to a U.S. Naval to U.S. Navy ship. But the U.S. economy, this U.S. earnings, the stock market have been remarkably resilient since the beginning of the decade. When you think of all the stress tests that it has passed, and we've listed them for you before, from the pandemic, the lockdown, the supply chain disruptions, the inflation, the Fed tightening, tariffs, mini banking crisis, Russia invading Ukraine, and now the situation in the Middle East. And yet the U.S. economy still seems to be doing pretty well. I know that there was some slowdown in real GDP during the fourth quarter of last year and the first quarter of this year, but we attribute that to a large extent to the government shutdown in the fall of last year, and then of course the winter weather was worse than usual in December, January, and February. So we're seeing some signs of things improving in the March data, and we think they'll continue to improve in the April data. I think the consumer will continue to do what they do best, which is consume, which is the point of our morning briefing. By the way, this is, I should have mentioned, this is actually a second take. I'm recording the call that I already did about a half an hour ago, because we had a technical glitch, so that we didn't record it, but now we're recording. Want to make sure that everybody has access to what we're saying. But why don't we just jump in and look at some of the charts that are relevant to updating the resilience of the economy. And let me just find them here. Right there, market call. Okay. Okay, so we have been starting out with our QTs, the quick takes, because that's where certainly on Sundays we give you an update on some of the key market variables that we're watching. And so maybe this is going to turn out to be a contrarian indicator here when a Wall Street strategist says up, and away. Maybe it's not going to go up in that direction. So consider this backward looking rather than forward looking. This is not advice that it's just going to keep going up, and away, though. I'm still using 7,700 by the end of the year and 10,000 by the end of the decade. So I guess I am still in the up, and away, looking further out. But on a near-term basis, I'm looking backwards here, and the economy's been, and the stock market and earnings have been going up, and away. Stock market, this is the S&P 500, market cap weighted all-time record high last week. Then we had the laggard here has been the equal weighted, but the Magnificent Seven are magnificent again, outperforming again. All those concerns about these companies spending too much money on AI infrastructure, and it's not clear whether they're actually going to make any money on it. That's suddenly not a big concern. Look, these are amazing companies, and the managements are telling us that they are seeing a huge demand. They're seeing it in their cloud business, a huge demand for compute to a large extent bolstered by AI. And so build and they will come. I guess some of these companies, managements are saying, if we had built already, they would be here and we'd have even more revenues from AI. But I'm siding with them. There is something rather unique about a digital revolution, and that is the more data we can process more cheaply and more quickly, the more data that we're going to do that with. There's it is kind of like Buzz Lightyear to infinity and beyond. There's always going to be more and more data, and the more that we can process it quickly, cheaply, to get important advances in our workflows, whether it be trying to cure cancer or going further out into space, or just doing a vibe code to create a desktop for yourself. They're all going to create more and more demand for AI compute, AI memory. Compute, of course, is different from memory. Memory, you need to build more and more memory uh, because memory has to store that information. Compute, you can use over and over again for computing purposes, but then again, if the amount of data that people want to compute just keeps increasing dramatically, then you need to create more compute infrastructure. So that, in a nutshell, is the way I see this whole AI evolution. It's an evolution in the digital revolution that started in the mid 1960s. Anyways, I digress. Let's go and look at some of the more recent developments. So people have been concerned that, well, once again, we've got a narrow market. We kind of joined the view that the market was broadening out at the beginning of the year, then the war hit, and now it seems like breadth is narrowing again. Then again, the Russell 2000 is at an all-time record high, and the Magnificent Seven demonstrated that they uh, they have a lot of ways to continue to increase their revenues and earnings, and so the valuation multiples looked pretty cheap back on March 30th. This you can look at on your own. It's just looking at the performance of a whole bunch of stock market indexes since the low of March 30th. We said on the evening of March 31, we said that was probably going to be the low for the year. We still think that's the case. Um, and yeah, it's been concentrated. Magnificent Seven has got is right at the top, and Nasdaq pure growth has done extremely well. So growth has been leading the way, but the Russell 2000 is right up there. We even have some transportation stocks that have done pretty well. The large caps is here, small cap and mid caps. I mean, these are still double digit returns since March 30th. So let's put things into perspective here. We pointed out that the ETFs that we're looking at are telling us that maybe, just maybe, the private credit concerns are sort of dissipating. We'll see. I mean, there's still a downtrend line in both of these ETFs, Virtus Private Credit Strategy and the VanEck BDC Income. Um, but let's look for a breakout in these things, suggesting that the concerns about these issues are dissipating. In any event, we've shown you bank loan data showing that bank loans are up 7%. The pace of increase in bank loan lending is going up. And that certainly suggests that there's no systematic problem with credit. If some of these companies wind up not being able to raise money in the private credit markets, maybe some of the banks will spend some time looking more closely at their loans, and they might get credit that way, or they may not, and there may be some problems in some areas of the private credit market. but we don't think they're going to become system-wide or a real problem for the economy. Uh, then we've got this chart that we like to show you every week, especially since it's been such a happy chart. This shows you analyst consensus expectations every week for this year, still going up. You wouldn't know there's a war going on. Still going up for 2027. And the time-weighted average of these two forward earnings, which is what we use for PE times E, all-time record high. This is amazing, right? Well, we've always pointed out that there tends to be an earnings hook once we get into an earnings season and all the data comes out. And so we've had another earnings hook here. This is one of the most impressive ever. We've gone from analysts thinking at the beginning of the earnings season that maybe earnings will grow 12%. Now, as the data is actually coming in, they are up to 18.5%. That's a huge increase in the growth rate on a year-over-year basis in the one quarter. Hasn't well, it hasn't caused them to significantly raise their outlook for the first for the second, third, and fourth quarters. But on the other hand, it hasn't stopped them from continuing to raise those estimates. So analysts are very bullish. They've been bullish throughout the war. The PE came down, and then I guess on March 31st, investors said, "Well, wait a second. The PEs are down a lot. Stocks are a lot cheaper." But they came down not just because stock prices came down, but they also came down because earnings are an all-time record high. And so you're getting all-time record highs with a big drop in the valuation multiples. Hey, let's buy. So there's a lot of buying on the dip, and we were all for that. Meanwhile, the breadth of earnings continues to increase, as you can see from this chart. We've shown it to you before. Percent of S&P 500 companies with positive 12-month percent changes in forward earnings and forward revenues, up to 87% for revenues, up to 82%, 83% for earnings. This is kind of consistent with a bull market, certainly not a bear market. And this is consistent with the possibility of these things going higher and not necessarily peaking, but kind of staying there. And again, consistent with a longer term bull market. Meanwhile, speaking of broadening of the market, earnings have broadened out, which suggests to me that certainly explains why the Russell 2000 has participated in this rally. So here's the S&P 500 forward earnings. Here's the mid caps, and here's the small caps, and they're all at record highs. Same goes record highs for overseas. This is the US MSCI forward earnings. And this is the rest of the world all-time record high. And you can see that for a while that it was going up, but more slowly than the US, and now it seems to be picking up. Maybe that's Taiwan and South Korea uh, in terms of being AI trades, but I think it's actually somewhat more broad than that. It could turn out that not only is the US economy resilient to the war, but maybe the global economy turns out to be more resilient than anybody expected. Here's those valuation multiples. They took a big dive here, actually for the Magnificent Seven. They started back in late October when Michael Burry badmouthed them. I hope he covered his position because he did make some good money here when the PEs of these things came down, the prices came down. But right around the end of March, investors looked at the situation and said, earnings all-time record high. We got a huge drop in the PE. We're not going to have a recession. Let's buy. And that's what happened. We'll skip that. Then, people, a lot has happened here in the past few weeks. I think we're taking a lot of concern. There's been a lot of concerns about this being another tech bubble, like here when the PEs for tech just went off the rails, uh, especially relative to the S&P 500. Here we've actually seen the technology PE come down and can kind of be a market multiple, which is very encouraging indeed. Back here we had stock prices going up without earnings support. Here we have had stock prices going up with plenty of earnings support. Uh, Sentiment, we use that as a contrarian indicator. There's more bullishness, but not uh, uh, the bull-bear ratios are still not high enough to warrant being concerned about a pullback or a correction. Back here, when we saw these very high readings earlier this year, we said there are too many bulls and there's probably going to be some pullback uh, and possibly a correction. All right, the topic of the morning briefing. Uh, let's go to the topic of the morning briefing is consumers still doing what they do best. And the resilience of the economy, and we've been using the R word really since the beginning of our roaring 2020 scenario. An important reason for the roaring 2020 scenario is our perception that the economy is resilient, that it can withstand these shocks that in the past might have caused recessions. It's recessions that cause bear markets. If we have fewer recessions or shorter recessions, and shorter recessions, then the resilience of the economy might also be based on productivity, based on consumers surprising us with their resilience. And all that's been happening. And I hope you've been enjoying the roaring 2020 so far. A couple more years to go, and then we can start talking about the roaring 2030s. But a big part of the roaring 2020s is the assumption that the consumers will continue to spend. You can see this as consumers spending as a percentage of GDP. This was a big increase in healthcare spending, and now it's kind of leveled out around 68%. So a great, majority of the economy is based on the consumer. No surprise there. The consumer sentiment, the latest uh, stress test. There have been a few stress tests here that since the pandemic that have brought consumer confidence down, consumer sentiment, I should say. And we've got the stress test of the oil prices going up and the Middle East crisis. This is not too surprising, but on the other hand, it's been totally useless for trying to predict what the consumers are going to do. And so we're not paying much attention to this particular number. As we've often kind of said half in jest, when Americans are happy, we spend money. When we're depressed, we spend even more money. And sure enough, through thick and thin here, I mean, the pandemic caused consumption to go down. We did in 2007 during the great financial crisis. We had a decline in real consumer spending. So recessions obviously are going to be occur when consumer spending retrenches, but there's no retrenchments going on. All-time record highs for inflation-adjusted goods spending on everything, including services and goods. The slowdown in the economy in the fourth and first quarters, we think, was the government shutdown in the fourth quarter, and then bad weather, worse than usual weather for December, January, and February. We're expecting to see a nice rebound in the economic growth rate, led by consumers. You can see retail sales, the weekly Red Book retail sales number. That actually looks like it's accelerating. It does not include gasoline station sales. It's mostly department stores and discount stores and the like. And it does tend to be a pretty good coincident indicator, but it's weekly, so it gives you it's almost a leading indicator from that perspective. Meanwhile, despite being depressed, I mean, because they're depressed, Americans want to travel more, and you're not seeing any signs in the in the TSA checkpoint travelers uh, index suggesting that things are slowing down. The airfares are up, the oil prices are up, and yet they're still spending. This is a weekly indicator of real GDP growth put out by the New York Federal Reserve Bank, and you can see that it's actually the blue line. The growth rate seems to be accelerating a little bit, and this is a good indicator of year-over-year percent change in real GDP. Again, consistent with our view that things might actually be getting it better in the economy. The naysayers say, well, that's not sustainable. How can that continue? Consumer spending is going up. Disposable income's going sideways. How can that continue? The savings rate's going to go down, is going down. How could that continue? Um, Wages are uh, s- wages are going down. They're down to 3.5% roughly, and prices now with oil are up about the same. So real wages aren't increasing. So how can that be sustainable? How can this drop in the savings rate be sustainable? And the answer is we've talked about it many times before. The baby boomers have $89 trillion of net worth. They're retiring, and as they retire, guess what happens? They're not getting paychecks anymore. So disposable income is going to go sideways as they have all these high earning baby boomers retiring. And meanwhile, they're going to continue to consume. And so I think that kind of explains the likelihood that consumer spending continues to grow. This you can see this is more and more of them are retiring based on the Social Security benefits numbers. When you look at real spending by consumers, you see healthcare, financial services, recreation. You can see the fingerprints of the baby boomers all over consumer spending. They're going on cruises, they're flying around, they're staying in hotels, they're going out to dinner, to lunch and breakfast. And so they're keeping the economy growing. And I think that they're helping the young adults. There is an affordability crisis for young adults. But meanwhile, look at this. Personal consumption and expenditures for fun-related, all-time record high. For travel-related, all-time record high. For housing-related, all-time record high. I think a lot of the baby boomers are staying put in their houses and remodeling and maybe buying new furniture, new appliances. Um, there is an affordability crisis, and I think a lot of that has to do with demography, younger people. This is singles versus married couples. So there's more singles now than married couples. Look at how that's changed. And the singles are the ones that are facing the affordability crisis. And I think a lot of these married couples are the aging, older baby boomers that are helping their young singles. I know this from personal experience, my own experience and my friends. Meanwhile, helping the economy reaccelerate here, we've got tax refunds bigger than they were last year, offsetting most of the increase of gasoline prices going up. Meanwhile, the labor market indicator suggests that the labor market may surprise us and show better employment gains. And you can see this is initial unemployment claims versus unemployment. The initial claims are coming down. And so that suggests that the unemployment rate may actually be down, be heading lower. The ADP data, I'm not a big fan of it unless it supports my story, and that's what it's doing here. The ADP data suggests, the weekly data suggests things are getting better. The Indeed job postings seem to have stopped going down, and now they seem to be heading higher. Consumer credit year-over-year percent change was the growth rate was falling. It turned negative last year. Now it's turning up again. So consumers are spending and they're using their credit cards. So that kind of covers the main points. Again, I kind of this is a re 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 recording of what I did live about an hour ago because our we had a technological glitch. I love technology, but it does glitch every now and then, and sometimes you have to reboot everything to get things going again. But anyways, we saved the day here, I think, and I hope you enjoy this recording. I hope you have a good week in the markets. All the best.